I think the same rules applied 50 years ago, applied 5 years ago, apply 20 years from now. First of all, you have to know what you own, whether it's a fund or a stock, and you have to have a reason for it. And you ought to be able to explain to an 11-year-old in 2 minutes or less why you own this. And this sucker's going up is not a good reason. I've tried that one. Doesn't work. Basically, you look now, you have 3 choices. I think if you're an investor, you can put your money in a money market fund and get 1.7, 1.5, 1.6, and it's taxed at a 40% rate. Or you can buy a 10-year treasury and get 4.7. That's taxed at a 40% rate. Or you can have some equities. And I think stocks over the next 10 years will do a lot better than 4.7 or 1.7. So I would have some of my money. Now, it's up to the person to decide how much they want to have in the stock market. For some people, 10% is aggressive. For some people, 50% is the right amount. It's a personal decision. And you can't go by these rules that if you're 25, you should be 100%. And if you're 45, you should be 50%. If you're 60, you should be 0. And I guess burping a lot. I don't know what the rules are on people at 60, but I hate those rules. I think they're pathetic.
Why are you confident that stocks will be a lot higher in 10 years?
Well, they're not lottery tickets. I mean, when you own a stock, it's a share of a company. And I think companies are going to make a lot more money in 10 years, a lot more money in 20 years. And that's why they go up. It's the only reason. Some companies don't do well. Zero Hutchins make a lot less money than they did 30 years ago. It's a lot less. More companies are earning a lot more money than they were. And that's why stocks go up. Corporate profit has gone up 40-fold since World War II. Stock market's up 40-fold.
It's 25 years since you started running Magellan. You have been director of research for Fidelity. You've been with them since, I guess, 69. What are the most conspicuous mistakes you've seen investors make?
Well, I think not looking at the balance sheet, and this is a mistake I've made. If you look at a person's balance sheet, you look to see what the assets they own, their houses, if they own a house, if they own a car, what debt they have, and take that away. That's what your net worth is. You should do that with a company. And I've seen investors look at companies that let's say looking at 2 companies, they're very depressed. They're each at $4 a share. And they're each losing a couple $1 million a quarter. One company has $100 million in cash and no debt. And one company has no cash and $100 million in debt. They're about to blow taps in the second company. So you could do this. If you get through 8th grade math and you get anywhere near 8 and 8 equals 16, you can do this. Look at a company's financial position. It's impossible to go bankrupt if you don't have any debt.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Did that incline you to sell too quickly sometimes?
I think my greatest mistakes are, it's funny, on a stock, all you can lose is 100%. I've done that. And your great mistakes are selling a good company, and it doubles, then it triples and quadruples, because you make a lot of mistakes. And so it's ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are saying, oh my God, this stock is too high. And I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my 2 greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they're around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. I'll be able to write that down and follow that. That's what I do with a company. And that's your decision. That's how you sell it. You still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because their earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you got to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You could lose a lot in the stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.